Hello, gentlemen and lovely ladies. So, Dow Jones, quick update and follow up. So, a lot of people got a bit jumpy after our call that this was a sell from the 24,700 levels. And in fact, if you were trading the primer on an ascending inverted HVF, you could have been short on the break of a grind line up top there at virtually 25,000 and on the break of 25,000. So, as we progressed, we had initially gap down, which respected a previous funnel level on an upside, down, triggered, made first interim, rallied back in, just did a gap closure on a spike shooting star, came down, jumped over our tripwire area as well, which is our low 3 again, down, this time barely could return move to the interim, spill, capitulative, and then yesterday people were concerned. And of course, if you're HVF trader and you're sticking to process, you expect after a second interim to have relief rally. You've got to gap up and trade up. Everyone was very worried. Oh, you see the bears are all being caught again. You always should be buying the dip. As I said on the first video, this is a high quality inverted HVF. On balance of probabilities, nobody can ever tell you they know anything. On balance of probabilities, this will not only run this target here at 22,400, which you could have been short from, as I said, at the 25,000 level, but it's likely to overperform on this level, potentially significantly. So this rally here had a lot of people shaken out. Everyone is emotional. And everybody wants to be short when it's fallen. And then when the opportunity comes for a second chance short, they're petrified and they think, oh, it's going to fail and it's going to go up. This is what's called emotional aspects. You all want to buy the certainty or sell into the certainty. And then when the opportunity for the second chance comes, your confidence drains away. Why? Because you don't trade to a level. You trade with momentum. Everybody is a momentum chaser. We're like puppy dogs chasing cars. The car stops. We have no further interest. Or we don't know what to do with ourselves and we're vexed. The opportunity is to trade to a level with confidence and a method, and this could have seen additional shorts put on. I did have limit orders. Unfortunately, I wasn't filled. I thought there was even a chance we could get a little bit higher, and I didn't get additional on that. What subsequently happened in roughly the last few periods of the day is you got a strong sell-off in as many hours as this is up. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. That's over 2 trading days there. When did we start on this rally? The afternoon of 2:30 of the 26th. Then you were still at the high point there. You're on the 27th, so you had half a day on the 26th and then the full of the 27th, all about the rally, and everyone would have been, yeah, you see, it's just another opportunity to buy the dip. And what did you get in the next 3 hours? The next 3 hours undid a day and a half's exhaustive gap up rally. What did you then do? You came and virtually, not fully, but you virtually closed the gap on a hammer. With a final little bit of nibble buying at the end. So what's probably going to happen here? Probably it's going to calm down a small amount. I suspect you're going to get some form of downside continuation structure. Our overall bias on balance of probabilities remains a downside view. That means we are expecting success on balance of probabilities. That just means we could be wrong. As with anything, you can be wrong, but the dynamics of our method are indicating that there is more potential out there. And in fact, with the structure of HVF method, in fact, this could be a very high potential trade. In other words, not only is the target on the card, and we continue to assert that as an on-balance probabilities, but an exceeding the target by some method, and we'll utilize methods that is part of our program. Come on to the webinar, themarketsniper.com freebie, 29th of March at 7. That's right, 29th of March, that's tomorrow, 7 o'clock, and grab the webinar for that. So what do I anticipate now on balance of probabilities? What will happen next? I think you could rally again and everyone will go, yeah, you were wrong, it's not going down, etc., etc. All the people that will be excited about the current movement of the moment. These are what I call the 91%ers and the momentum chasers, and they'll all go on your YouTube channel. They'll crap all over the comment section, etc., etc., saying, yep, it's gone up, you see, it's not going to happen. It could even go up higher than this level. It could be a rising wedge. There are many different ways you can set up a structure for a later smash down again. What people don't realize is that this was an exhaustive push up that went very, very brutally from this ledge at the 24,800. Note the 25,000 key level of significance right here. Let me put it in. The 25,000. Oh, fancy that. A number like that. Oh dear, being a key level of significance. Who'd have thought it? So we put those in blue in terms of our protocol, and we make it dashed. So that is a key level of significance. And it is quarter of the way to 100,000. Is there any bigger number after 10,000 and 50,000 than 25,000? Probably not. Where did it do? It ran right through our HVFs, our funnels, all of this. In other words, it's splitting perfectly. Fancy that. I mean, I'm just noticing this now. This is a live observation. And there was all part of this little ledge structure here. Of course, you get interaction at a key level of significance like that more often than not. As a non-balancer probability trader, that is what I would say has high likelihood. When you broke out of this, you went immediate melt up, essentially, to 27,000. 26.6 odd over there. This was in very short succession. These are hours. If you look at this on a day, you'll see how quickly this was. You then had a breakaway gap to the downside. Breakaway gap to the downside after some upside gaps. Eventually, this upside gap got closed. Another upside gap didn't get closed. Up, closed, up. Then you get this isolated. It's called an abandoned baby if it's one candle. If I change the time frame to 4 or 5 hours, that's called an abandoned baby. Gap up, price action, and gap down. It's been left out there to dry, hung out to dry. It's very bearish. Continuation, gap again, spill, suddenly absence of bid, lots of margined, over-leveraged traders panicking to get out and just thinking protection and fear instead of fear of missing out. Down respike again, relief rally, late bulls buy the damn dip, some exhaustive gaps again, big absence of bid. So we get the whole ascending inverted HVF structure, and everyone is thinking while it'll trade up today, as I expect off that hammer, short term, it will encourage the bulls and the momentum chasers to get back in. They will help set up either this continuation structure as I've drawn here as one scenario cast of many, or you get even a rising wedge up to the funnel if you're lucky, and you might even get a final chance to short on the thick green line over there, which was our trigger entry level. I'm doubting you'll get your primer entry of right up top here, 25,000 again. But there is a gap that's unresolved on the downside. Who knows? But I don't, on OBP, on balance probabilities, don't see that one going down. So here we go. So what comes next? Next, after meeting this return for a while, a bit of progress decay, that's what we get. That's what we symbolize when you get interims. Anybody else know a trading method that tells you roughly once you run an interim that you might get adverse price behavior to prepare you emotionally? There was your break trade, gap down, first interim run. Guess what? Rally back into funnel, proving that this was a significant level. Sucked back up, then jumps over the fence, spills back down, runs second interim, rallies back up. Where's it stopping just before? What was the previous interim and turned out to be temporary support? Failure to break it and trade above it. Spill back down, continuation on balance of probabilities, continuation to the downside. Target 22,400. And you will also look for overperformance if you're smart and you understand. So that's total free forecast for you on the Dow Jones Industrial. If you want to learn more about this methodology and how you could be implementing this for yourself, how you could have determined before you noticed the 25,000 ledge here that this funnel area was highly significant, both from your primer, from a small mini upside HVF over there that led to an upside gap breakout, and the overall larger inverted pattern. There is no excuse, or there's no alternative to doing proper charting and understanding what's going on. By the way, this particular chart doesn't have volume, and volume is a key part of all analysis. So as another interesting point, I'm having to do this on the S&P. It is not the same index. I know that, you know that. This is a proxy discussion now because I was unable to get actual volume. Note that the rally, low volume. The sell-off was obviously momentous and explosively high volume, particularly over here. Then again over here, rally on relatively light volume, and then the sell-off again. dumping and quite a bit of fear in there. But the fear is abating following this. So the volume is dropping. What do you get? You get a weak rally again, moderate volume. You get the forming of continuation. It goes quiet. It goes boring. Everybody thinks, that's the downside. Done until the next spank. Where was all in the volume by price over this range? So we've taken a volume by price where we looked through this, basically where our funnel levels were on the Dow. If you look at this and this return move, you had your proper capitulation. This is a slightly different chart. You'll note that's higher than that. It wasn't like that in the Dow, but note approximately where you are on your Fibonacci grid from the 100 down to naught here. You're on the high point. Most of your big histos along price were just below the key point of the gap breakdown, which would have coincided on your Dow draw. Whoops, that's not the one we want. On your gap breakdown, probably here or here, confirming this funnel and 25,000 area. Regardless where it fell, it would have fallen here on the first gap or on the second confirming gap after a rally. Let's have a look at it again and see if we can pinpoint it. There's the first gap, so that's where our primary is on the Dow. That's the second gap confirming on the rally. Those three histograms are literally in between them. That's on the top side, that's on the bottom side of those three. So that volume is running right through this zone here, that light blue zone. And in the same way on our Dow, it would have run straight through that gap area and this gap area, right the way through. Note, it's where our funnel is set up for our macro inverted. It's where the top end of it is where the key round number level of 25,000 exists, and the volume would be at its maximum. Note it will run through also, although we didn't include that, the volume by price only started from here and here. It would have run through also this key period where you had a sustained period of bouncing in a range before breaking up for your final melt up. This is like a big shooting star on a mega bi-monthly or whatever time frame you need to get small candle down here, big tired wick up, all the way back down, smash down, and then you're all been trading at this level. What tends to follow a shooting star at the top of an exhaustive blow off? Sell off, sell off, sell off, bias to the bear. Many people get killed shorting indices. Let's just say this. Many people get killed shorting indices. They spend most of their time going sideways or grinding up. You will get killed shorting indices. It is actually a very brave call to call for an overperformance short downside on a indice, and it's one you can get regularly wrong. Trading head and shoulders, more often you are inaccurate on this. Reversals generally are something you get wrong. The difference with this is in HVF method, we recognize change of trend much quicker, and we trade continuation. In short, this is your slap in the face real warning. It's a proper sell-off, and we call that trend change. We call that trend change warning, slap in the face. It's the first strike of the lightning or the first cold snap of a winter. What do you get? Initially, you go back to normal and everyone thinks it's hunky-dory until it starts reasserting again. That's why a first move in a new trend often is expansionary and overperforms. I'm Francis Hunt, the Market Sniper. It's my distinct assessment that you could learn a great deal and be far more successful trading if you had methodology instead of emotion. Those that panicked out on this rally would not have known or had the confidence to stick to method, depending on where they got short. Being early is important. That sets up your risk to reward, your distance to stop, and your emotional comfort when the market is volatile and leaping around. We had an understanding that there was likely to be a reaction. Being prepared is forewarned. You know it's still compliant, as opposed to just watching your P&L and wetting your pants and hitting the panic button. Okay, that's my take. I hope you enjoyed it. This is not a recommendation. This is my assessment only, and it is a sample of what you would learn and get in terms of learning our methodology for trading markets. This is a significant moment for the equity indexes in my view. Thank you for watching. Please share and rate.